Sunday the 21st, Biden steps aside, markets trying to price it in, see what they're going to do. Grab a beer, let's try and make sense of it. Starting here, 2024, now the leading asset so far, gold. Maybe a little bit ominous, but hard to say. S&P was the top performer in 2023, and it's only not even 2% behind, so not a lot to infer just yet, but gold maybe giving us a little bit of a warning sign there. Interesting one here. This is how you end up getting a sell-off. There's too many bulls. Too many people got too far ahead of themselves. Almost 53% read. So let's see the week ending. I bet the next one there'll be more bears, and as soon as we get a little bit more bearish sentiment, probably can start getting the next leg up. So let's see. Now, for sector valuations, move my dumb head out of the way. Honestly, there's a lot to like out there. I like utilities, I like financials, I like energy. I like the setup for these for years to come. I like real estate to rebound. It's really just a couple of these guys over here. Tech being almost double the historical valuation. Consumer discretionary tends to do pretty well, but the S&P has this forward priced earnings valuation here of above 21. Historically is closer to 16, but in the 10-year average close to 18, 5-year average above 19. So these structural valuations are getting elevated. People want to call it a bubble. I'm just not seeing it yet. Now, people want to talk about this one too. One of the largest weekly inflows into small caps ever. But before we can celebrate it, people want to say the last time that happened was 07, 08, and then there was a big crash. So a little bit of doomer action. The homie Blake Stonks has this crude oil chart, textbook, downtrend, touched the downtrend, could not break support. Oil as a proxy for energy markets showing a bit of weakness. Maybe demand is down. We're in peak summer travel months. In theory, this should be rocketing. It's not. Maybe a little bit of a sign of weakness there. Credit spreads have started to creep upward, but look here, this is in the triple C to single B, so we're in some real junky areas. You'd want to see credit spreads getting blown out between investment grade or between corporates, privates, publics, treasury. You'd start to see some dispersion. But from triple C to single B, it's still something there to infer. Now, people keep calling the market overbought. If it's overbought, it's overdone. It needs to pull back. Well, S&P 500 stocks, when more than 28% of them have a 14-day RSI above 70, so, more than a quarter of the market being overbought, let's say. The forward returns for that, it's up damn near all the time. You can see all of these instances. There's just not really any sharp pullback that results from these according to the data. So, if you're a position trader, you might catch a bit of a move down, but when there's strength in the markets in a secular bull trend, it's hard to be a bear. Market coming up, there's always stuff going on. I think what you got to look out for the most, these job claims on Thursday. If unemployment accelerates, you can infer economic weakness is ahead. We're not seeing that just yet, but it's creeping up there. And then the Fed's preferred PCE indexes. Jerome Powell supposedly likes that one more than CPI and his other inflation reads. So see how that goes. Got some earnings. Getting into the thick of things here. And this might be a good time to say it. There's always a temptation to say the market is doing something for one reason or another. It's because Biden is stepping down, the market's pricing in Kamala, or the market's pricing in Trump, it's ramping up the corporate tax rates, or whatever. Follow the earnings. Look at the charts and follow the earnings. That is going to be a better strategy than just about any other. Look at the data, look at the fundamentals, see how companies are doing, and that's what Wall Street cares about. These politicians and their clown show, man. I've got my eyes on Tesla. That's always an interesting one. The big tech, mega cap stocks have been ramping, but Tesla still is about 40-50% off of its all-time high. So that's a good one to look out for. And we'll see how it goes. Now, getting close to the cutting cycle here, something to keep in mind, the Fed does not cut out of the goodness of their heart. When they do cut, you tend to see some weakness, but not necessarily immediately. So it's good to keep this in mind. When they start cutting, you see, you could go up in certain cases, you can keep going up in certain cases, you can fall off in certain cases, but you don't want to start getting in or out of a position immediately. You give it some time. Pay attention to the data. Speaking of data, May through July will be wrapping up soon here. Interesting read here. August tends to not be so hot, including when you get positivity from May through July. You can see a lot of red reads here. And then when S&P performance is negative from May through July, oddly enough, you tend to see some more positivity there. So interesting one there. Treasury market, not a whole lot to look at here. Interesting though. I mean, this is to be expected. You can get a T-bill for 4 weeks or up to a year. A lot of people are sitting in these T-bills for 3 months at a time, collecting 5.25% risk-free. No reason to be in a bond. This is a sovereign issue for the United States at one point or another. These long-term yields are going to need to go up if they want to issue these things. But just one of those things. Pete, we've been calling for that to be problematic for quite some time now. It hasn't been problematic just yet. And if you can collect this T-bill risk-free, why not? Who wants the duration risk? And should have probably put this one toward the front of the video, but when we're looking at thematic rotation, we don't want to get into every single granular detail here, but look at AI and semis. Been ripping. Mega cap tech ripping. Tech ripping. Get my words wrong here. The ones that had been doing the best did poorly last week. Some of the items that had been doing the worst year to date did well last week. This is hard to say this is a theme for the second half of 2024 just yet, but July certainly opened up with a massive unwind. I'm sure in the weeks or days or months ahead, we'll get some information about some hedge funds or these long short funds, which ones did well, which ones did poorly, or who had the wrong items on their books and who had to do some crazy maneuvering to make sure they were positioned accordingly. But let's see. Let's see if this is a trend that is going to continue and mega cap tech is going to roll over. Then, things could certainly get interesting. But we've seen good rotations into some value plays. Small caps did well. We looked at the valuations, places like utilities and real estate and energy, some of the interest rate sensitive areas. Hey, you never know. It doesn't mean you'll have to run for the hills. If we see some weakness, there may be some opportunity elsewhere because there's always a bull market somewhere. Alrighty, folks. We'll check in with you later.